This is huge. The Fed just confirmed they'll be ending QT on December the 1st and will start buying treasuries again. Let me translate. The money printer is coming back online, and it's yet another reason you need to be holding Bitcoin. Let's break it all down so you can understand why. If you've seen my recent video, you'll know what's been building up to this, but here's the simple version. The Fed has been tightening, draining liquidity out of the financial system. At first, that liquidity came from the Fed's reverse repo facility, the yellow line on the chart, but it's now almost at zero. So the system's been drawing on the next source of funds, bank reserves. That green line shows bank reserves as a percentage of GDP, and they've now fallen below 10%. That's a big problem. When those reserves get scarce, banks stop lending and things get ugly. 10% is a level that's triggered instability in the past. You can see it clearly here. The red line, the SOFR rate, is now well above the Fed's target, to levels we haven't seen since 2019. We'll come back to 2019 in a moment, but first, here's why those reserves are falling so fast. The US Treasury has been issuing record amount of debt in the form of short-term bills, but with the reverse repo facility empty and the Fed still tightening, banks are the ones forced to absorb that debt. Look at this chart. The blue line shows the Treasury General account. That fills up when the Treasury borrows more. It's been climbing rapidly in recent months, while bank reserves have plunged, and that correlates directly with the spike in the SOFR rate. In simple terms, the government is issuing too much debt too fast and the system can't handle it. And that's why Jerome Powell just announced the end of QT. Officially, they say they'll hold the balance sheet steady, but in reality, that is not enough. The Treasury will keep issuing bills, and the system, now far bigger and more leveraged than ever, needs growing reserves just to stay alive. In 2019, the system broke when reserves hit 7% of GDP. Today, it's already cracking at 9.7. And let's look at what actually happened in 2019. The Fed tightened too far. SOFR rates exploded. Interbank lending froze overnight. They had to reverse course fast, injecting $400 billion into the system in just 6 months. Now, they'll have to do it again. And when the Fed prints, it prints big. 2008, 1.3 trillion. 2013, 1.6 trillion. 2020, 5 trillion. The problem this time, inflation is already out of control. It's been above the 2% target for 5 years now, the biggest stretch since the 70s. And this isn't just any money creation. This is monetizing government debt, the most inflationary form of all. The Fed can't escape this cycle. Tighten, something breaks. Print, inflation takes off. And the markets already see it coming. Gold has been on a historic rally, adding nearly $10 trillion to its market cap. A move that big, that fast, means the biggest players on earth are repositioning for inflation. But at some point, that trade becomes overdone. Gold can only absorb so much capital before it's fully valued. Bitcoin's market cap is still less than 10% of gold's. So when those same allocators start looking for more exposure to scarce assets, even a small fraction of those trillions flowing into Bitcoin could send it to levels that make this gold rally look like a rounding error. If you want to understand more about all of this and how to prepare for it, hit the follow button.